So may I start by welcoming you all today to the Thought Leadership webinar on wealth taxes, the future of taxation in a post-COVID world. For me, it's mid-morning, but I hesitate to say good morning because we have a truly global audience and the time of day or night for attendees is very different across a number of time zones and countries. The Thought Leadership series of webinars will bring you virtual access to the most topical content from the STEP Global Congress Programme, which we were unable to hold in 2020 due to COVID-19. And this will lead in to the rescheduled event in Dublin 2021, which I hope many of you will sign up to. This series offers an exciting programme of 6 live webinars covering a number of topics, with Q&A opportunities with our expert speakers, as we showcase the breadth of interests of our STEP membership and provide up-to-date knowledge on the subjects that matters to our industry. Before we start, I have a number of housekeeping notes. I'd first like to thank Rawlinson and Hunter for their kind support in sponsoring this webinar. During the webinar, your microphones and videos have been switched off and the chat function has been disabled. However, if you have a question for the panelists, please use the Q&A function, which should be at the bottom of your screen. We'll answer as many of these questions as we can at the end of the session. And finally, we'll be recording this session and it will be available to watch on demand. You'll receive an email with a link to the recording later today. We have 3 world-class panelists today who I'm privileged to introduce to you. We're going to finish with Philip Marcovici, who's established his own firm, the offices of Philip Marcovici in Hong Kong. Philip's retired from the practice of law and consults with governments, financial institutions and global families on tax, wealth management and other matters. In 2013, Philip received a Lifetime Achievement Award from STEP and sits on STEP's Public Policy Committee. Philip's the author of The Destructive Power of Family Wealth, which was published in 2016. Before Philip, we're going to hear from Emma Chamberlain, OBE, who's a barrister at Pump Court Tax Chambers. In addition to being a barrister, Emma's a member of STEP's UK Technical Committee. Many of you will know Emma from her lectures and appearances at a long list of STEP events, as well as being the co-author of Trust Taxation and Estate Planning, amongst events, as well as being the co-author of Trust Taxation, amongst others. Emma has been on secondment to HMRC and HM Treasury numerous times, and earlier this year was one of the lead authors of the report published by the All-Party Parliamentary Group for Inheritance and Intergenerational Fairness. Emma's currently working on the Wealth Tax project, looking at whether the UK should have a wealth tax, in conjunction with the London School of Economics and Warwick University. And first up will be Patricia Garcia Madiero of Avantia Asesoramiento Fiscal y Legal in Spain. And Patricia leads the international private wealth practice at Advantia. Her practice has gained significant recognition, including from Chambers, Legal Media Group, and winner of Boutique Firm of the Year in the STEP Awards. She's ranked among the top 200 global practitioners in the private client global elite run by Legal Week and AML. And Patricia is a committee member of the STEP Cross-Border Estate SIG and the panel of experts of STEP Private Client Awards, as well as being on the steering committee of the International Wealth Advisors Forum. So before we start, I should explain that we'll be using the polling function to take your views on 3 questions during the webinar. The functionality is limited to yes/no answers, so that's how the questions have been framed. There'll be around 10 seconds to answer each question and the results will be posted straight away. The first question goes to the heart of the debate around wealth taxes, which relates to how governments try to raise the additional finance needed to rebuild national treasuries. So to start, the question is, for those clients that currently do not pay wealth tax, will they support a wealth tax? Or for those clients that already pay wealth tax, will they accept an increase? Were they the ones that put 115 down? Sorry, I've only seen one letter for an offer. So there we are. We have it fairly substantially that our audience think that a wealth tax will be deeply unpopular. Perhaps no surprise, but we shall see. So moving on to our first presentation, Patricia is going to explain how wealth tax works in Spain and how it interacts with Spanish inheritance tax, And she's also going to outline some of the considerations that advisors and clients should take into account when dealing with wealth tax. So without any further ado, over to Patricia.
Thank you very much, Tony. Good morning and good evening, everyone, wherever you happen to be. I will start off by laying out a little bit of history about Spanish wealth tax. Spanish wealth tax was first introduced in 1977, and it was introduced as a temporary measure in order to monitor and gain knowledge of individuals' wealth, and also to monitor changes in wealth as a way to detect potentially undeclare income and gains for Spanish income tax purposes. That would remain the case until 1992, when it became a permanent tax. And that tax has been applied on and off throughout the years until the present date. So we do have a fairly good knowledge of how wealth tax works and the breadth of experience in dealing with wealth tax in Spain. At present, it is a tax that is devolved over to the Spanish regions. And there are minor changes between the regions, except in the case of Madrid, which is currently running and full exemption from the tax. For how long, it remains to be seen with the changes that are expected ahead in 2021 onwards. It is a tax that is minor in terms of tax revenues in Spain. So Agnes, if you could upload the first slide, please. As you can see, this is 2019 statistics from the Spanish revenue. Wealth tax collection amounted to 1.2 billion, approximately half of which was collected in Catalonia. So even if the tax was eventually reintroduced in Madrid, which is the second, the first wealth center in Spain, its revenue would likely still be marginal in terms of collection. If you can compare it with the big cash cows, income tax is nearly 87 billion, VAT nearly 72 billion, and at present the collection is even lower than non-resident tax, which in 2019 is stood at 2.4 billion. It is best illustrated in the next chart. Agnes, if you could move on, please. You can see how the revenue collection figures are in Spain and the marginality of the wealth tax collections in Spain. Thank you, Agnes. So the main significance of this tax is not really, as we've seen, in terms of the overall tax collection, but it does have very significant impact on those taxpayers who are subject to the tax, which is a small segment of the populations, those who have net worth in excess of 700,000 euros at present. So the significance of this tax is really two-sided. It does have an economic impact on those taxpayers who are affected by the tax, but it also has a social and political impact and implications for the population at large, which typically views this tax as a way to kind of redress the imbalance in society. So in practice, it means that, of course, 99 or 80, whatever % of those who are likely affected by the tax are likely to vote no at the introduction or the increase in the tax. And if you ask the general population, they're likely, to get a majority vote, yes vote for the tax, largely because they will not be affected by it, and largely because they feel that this small segment of affluent population should contribute more. So speaking from the trenches of Spanish wealth tax and out of our long years of experience dealing with it, I'd like to address in my opinion, the 7 key factors in order to deal with the wealth tax for either in a jurisdiction that is, where wealth tax is likely to be introduced, or in a situation where an individual is planning on transferring his or her tax resident to a jurisdiction that imposes a wealth tax. So 7 considerations very quickly. First consideration really is territoriality and the scope of the tax. Wealth tax is usually linked to the tax resident status of the individual. So like is the case in Spain, people who are tax residents in Spain are taxed on a worldwide basis, whereas if you're non-tax resident and do have a Spanish assets, then you're taxed on a situs basis. So you need to consider a key factor in planning for wealth tax, as well as any other personal tax, the tax resident determination and issues regarding an individual. The second consideration, does it tax worldwide wealth or just certain categories of assets? In Spain, it does tax worldwide wealth, and that's something that you should bear in mind and take into account. You should also consider the implications of the special regimes available on impact on certain repatriations. We do have a special repatriation regime in Spain, as is the case, as you may already know, in Portugal, Italy, and even the UK. Under the Spanish special repatriation rules, you're liable, if you qualify for this regime, you're liable to Spanish wealth tax only on Spanish situs assets, even though you're technically Spanish tax resident. And finally, on this issue, you should consider the implications of the double tax treaties, because many of double tax treaties also cover wealth tax as well. Spain has 89 double tax treaties signed, but only 62 of them cover wealth tax. And out of those 62, 24 of them have special clauses regarding corporate wrappers in the cases of holding real estate assets, in this case in Spain. So do consider the implications of the double tax treaties when dealing with the tax. Issue number two is the issue, of course, of valuation. People tend to assume that it's a kind of mark-to-market valuation for all assets. That's not necessarily the case. In Spain, we do have mark-to-market valuation basis for quite a few, majority of assets, but we do have quite a few of those who do not use mark-to-market valuation rules. Typically, real estate, you go to acquisition cost or administrative values. Importantly, unquoted shares are typically taxed on a net book value basis. And, of course, you also need to take into account what is market value for those assets that are valued on a market value basis. And there will be assets that are difficult. There will be issues to be dealing with, like, for example, if you split ownership between legal ownership and beneficial ownership, what is the market valuation for those assets, etc. The issue number three would be the exemptions, and this is an important aspect of the tax, certainly in Spain. So do consider the exemptions available, typically pension plans, agricultural property relief, and critically in Spain, and I'd say in all jurisdictions, would be business property relief, which is a major mechanism to plan for the tax. For business property relief, the issues to be considered, among others, is obviously how you qualify. What is the definition of a business asset? Because those are typically, that raises out quite a few queries. What is the definition of a business in itself? For example, if you do have a large portfolio of real estate, does that qualify as a trading business and therefore qualify for exemption, or is it just a passive holding kind of category of assets? Issue 4 would be the limitation of tax in cases of limitation of income and gains. That would be in the case of illiquid scenarios. How we do have provisions in Spain, which very simply, if the less income that you have for income gains that you have for income tax purposes, and the less income tax you pay, the less tax that wealth tax that you end up paying. The marginal rate in Spain of wealth tax is currently 2.5% over net worth in excess of 10.7 billion. If you put into effect these limitation clauses, the marginal rate will go down from 2.5 to 0.5. So it's a mechanism that is of critical importance for those who have a passive portfolio of assets and cannot benefit from business property relief. Issue 5 would be the rates, good old rates. Is it a flat rate? Is it a progressive set of rates? In Spain, we do have a progressive set of rate mechanism, which typically means that families do tend to spread assets among family members as a way to keep marginal rates down and to lower the impact of the wealth tax on them. Issue number 6, I'd say, is one of the most important issues, which is the interaction with other taxes, and that is of critical importance. In Spain, wealth tax is a key mechanism to plan ahead for the real wealth tax being inheritance tax. In order to qualify for the most important benefits for inheritance tax purposes, you need to qualify for wealth tax exemption as well. And we do have many clients who plan for wealth tax, not to minimize the wealth tax exposure in itself, but as a way to plan ahead for their eventual inheritance and gift tax exposure. And finally, the issue number 7, which is of great importance for cross-border situations, would be dealing with trusts and private foundations. Many jurisdictions have mechanisms to deal with these arrangements in their own legislation. That is not the case in Spain. Spain, you may be aware, there is a notoriously difficult jurisdiction to deal with trusts and private foundations. So we do have some rulings in Spain dealing with them, but we do lack a comprehensive approach to trusts. So this typically leaves foreign nationals who have trust arrangements as part of the home tax planning exercise exposed to the tax if they're deemed to have a taxable connection to a trust for Spanish tax purposes, typically because they're a settler or a beneficiary. So as you can see, the existence of the wealth tax and the projected existence of a wealth tax is not a neutral or relevant issue for private clients. It's a decision with major economic impacts for them, and also it kind of stirs, shall we say, strong emotions. So it's certainly a deciding factor when addressing a potential transfer of tax residence, and particularly into Spain. And it would be important that this is planned ahead on consideration of these 7 issues that I've just outlined. So over to you, Tony.
So thanks very much, Patricia, for explaining the issues that are faced in practice where you have a jurisdiction that already has wealth tax. I think that's great background to set the scene for us. We've now got our second question, which is, do you think your clients will move the place where they live to avoid paying additional taxes post-COVID? Of course, this does presume the fact that there will be additional taxes post-COVID, but I don't think that's such an outrageous statement. So we should get the results momentarily. So pretty evenly balanced, but then, you know, baby, that I'm actually a little bit surprised how high the number of people who are prepared to move. You know, it's been a tenet of my thoughts is that, you know, don't let the tax tail wave the lifestyle dog, but, you know, I'm sure you know your clients well, and that's a really interesting statistic. So thank you. So we're now going to ask Emma to talk to us about the research she's been undertaking into wealth tax in the UK, alongside some academic bodies at the LSE and Warwick University. So over to Emma.
Good day, everyone. Well, over the summer, I've been working on a wealth tax project chaired by Gus O'Donnell, who is former head of the civil service, and working with a unique mix, I think, of academics, including those from Warwick, the London School of Economics and Oxford, and also practitioners, tax barristers like myself, solicitors, the Institute for Fiscal Studies, and former civil servants. So if you could go to the first slide. 3 of us, Professor Advani from Warwick, me and Andy Summers from the London School of Economics, have been leading this project. And if you're interested, you can go on the website at the link I've given there and download the initial report and also listen to our project launch, which was at the Institute for Fiscal Studies. Over the summer, we've been running various workshops with practitioners, academics and experts from various countries, not only Spain, but Norway, France, Switzerland, and countries also that did have a wealth tax, obviously notably Germany and India, and also Italy, which has a sort of form of property taxes. In November, in fact, it will be earlier in November, it will probably be about the 9th or 10th of November, we're publishing the 12 evidence papers that are being done by independent people. 3 of them will be done by us, Advani, Chamberlain and Summers, but there will be others and they are independent. And then there are in fact over 40 background papers dealing with all aspects of valuation, liquidity, enforcement. That's done by someone formerly head of revenue. So it's a wide range, and please do have a look at them and please give us some feedback. As I say, they should be out in about the 9th or 10th of November, and you will be able to download them from the website. They are going to be published in the fiscal studies. Now, in December, the 3 of us who are leading this project will be producing our conclusions, and I'm not going to tell you where we're thinking at the moment. You'll have to log in on the 9th of December and hear what our conclusions are. You might ask, what is a tax barrister at Pump Court doing looking at a wealth tax? And I suppose my view is really twofold. One, obviously, is that everyone says they want a wealth tax, but nobody actually wants to pay it themselves. And the purpose of this project for me was to really have a good, thorough look at wealth tax in a more academic way, really working out what the design issues are, how other countries have done on wealth tax. And we've obviously heard a view from the coalface there, which has been really useful. The last time the UK looked at a wealth tax of any seriousness was 1974, and a very sketchy, skeletal green paper was produced then. If I tell you that the report, I think this will have 500,000 words, probably slightly more, gives you an idea of the scope of the report. So it is a sort of Merle's type scope, I think. So the next slide. What is a wealth tax? Just to remind people, obviously a wealth tax is a tax on ownership of wealth, and wealth is the total assets minus any debt. We normally tax net wealth, not gross wealth. In our project, we look at the distribution of wealth in the UK and the sources of wealth. Obviously, it's difficult to work out a sensible way of having a wealth tax if you don't actually know how your wealth is made up. And what we find is that the majority of wealth in the UK, at least for those under 2 million, is basically their pension wealth and their housing. Of course, the wealth tax, indeed, as Patricia has said, is not the only way to tax wealth. You can tax returns from wealth, taxes on dividends, rents from property, increases in asset values, and most countries, including ours, definitely do that. We may tax them at different rates from earned income, but we do tax them. We can tax transfers of wealth, and we do that quite ineffectively at the moment: inheritance tax, gifts, property sales, stamp duty. So there are other options, and a wealth tax is certainly not the only way, or even necessarily the best way of taxing wealth. So moving on to the next slide. If you want to tax wealth more, and we're always being told that we're a more unequal society, and there's some evidence for that, is a wealth tax actually the best way to do it? And the Institute of Fiscal Studies have written a paper, The Economics of a Wealth Tax. There are some real issues of economics and principle about a wealth tax. Is it right that somebody who earns their money and becomes wealthy in their lifetime has to pay an annual wealth tax? Should we not be taxing transfers of wealth more than actually holding wealth? And as Patricia's illustrated in the poll came over just before, how might people respond? What are the behavioural responses to wealth tax? And we've got both me as a practitioner and an economist looking at that. What do people do? Do they fragment wealth? Do they invest in assets that are exempted? Do they leave? Do they not come in the first place? What's the sort of avoidance paper? And evidence paper 4 looks at that. We've done a quite interesting paper on public attitudes to a wealth tax. Do people favour the idea? And if they do, what sort of threshold do they want it to start at? And what sort of rate? And Maury did some pretty quite in-depth investigation, interviewing people for a couple of hours, taking different focus groups. It's interesting that the public attitudes to wealth tax aren't varied by whether it's called something different, like a fortune tax, nor is it particularly party political. People on all sides of the political spectrum have similar attitudes, which is broadly in favour of a wealth tax. And you can look at that paper in early November. And we also look at international experiences of a wealth tax. We've just heard from Patricia. We look at Switzerland, which has a very different design, low threshold, low exempt threshold, cantonally based, fairly flat rates, raises quite a lot of money from its wealth tax, but of course Switzerland doesn't have a capital gains tax, so you're not necessarily comparing like with like. And we have the OECD who have written an interesting paper on the political and design lessons of wealth tax. Essentially that if you start introducing exemptions to deal with problems like valuation or liquidity, that undermines the base of the wealth tax as a whole. So moving on to the next slide, my paper, which has nearly killed me this summer, has been the design of the tax base, who pays and on what assets and how much. So the first question is who pays? Who should be taxed? Is it the household or the individual? Spain taxes the individual, so you can have a husband, a wife and minor children all separately taxed with their own very high actually exempt threshold. Most countries have gone for a household basis of taxation, which would definitely not be the way we tend to operate capital taxes in this country. So Switzerland is a household, France is, Norway is. Some double the thresholds if you marry, others don't. So it's quite a different map out there. Now, what about trusts and foundations? How do we stop people splitting wealth or hiding it? We heard a little bit from Patricia on Spain, and obviously a lot of countries that have a wealth tax, Switzerland, France, Spain, don't necessarily have a strong trust tradition. They tend to use other vehicles like usufructs and foundations. That is very different from the UK, and we would need to think about trusts quite carefully. We definitely don't want to put people off setting up trusts for legitimate reasons, but we equally don't want fragmentation of wealth. And I've spent a lot of time on that. I think I've got a brilliant flow chart, and I would really welcome practitioners coming back with some feedback on that, and indeed academics when they read the paper when it gets published. How much should people pay? Now, should there be a cap on overall wealth tax? There is no country in the world that caps the wealth tax by reference to your capital. We heard from Patricia that Spain caps the wealth tax to an extent by reference to your income, but we don't have an overall cap on wealth tax. If, say, you're worth more than 20 million, should you pay a flat rate? And a banded tax like annual tax on envelope dwellings, which we've had in the UK since 2013, does operate in that way. And we look at whether there would be any mileage, and keeping it quite simple, banded, flat rate, fairly flat rate, and within the band you pay a set amount, and then above a certain level of wealth you just pay a maximum amount. Is that worth considering? Because I think wealthy people dislike complexity. Well, everyone dislikes complexity, but perhaps particularly wealthy people. And related to this, we look at the exempt threshold. Go high, like France or Spain, with a pretty high threshold initially, or stay low. Norway and Switzerland, it's a low threshold, fairly flat rates, and they do seem to be a little bit more successful in how much they collect and the general public acceptance. So just my second last slide to move on to now. Would a wealth tax work in practice? Well, should all newly arrived residents pay wealth tax on their worldwide wealth immediately on arrival in the UK? Or should they only pay after a certain period of residence here? France operates a 5-year exemption for new arrivals. Norway, you pay the moment you arrive. And I discuss the pros and cons of that in my design paper. And should non-residents pay only on UK situated assets like inheritance tax operates, or should it be limited to real estate? We don't really want to discourage non-residents from holding UK investments. Should we really be taxing them to wealth tax? What about those who leave the UK? No country imposes an exit tax on wealth that has a wealth tax, but some have a tail. So for example, Germany operated a sort of 10-year tail that you paid decreasing amounts of wealth tax the longer you left. France doesn't have a tail. As soon as you leave, you're not subject to wealth tax except on your French real estate. So my final slide, on what assets should wealth tax be paid? Well, when you look at countries, I think all of them have some common characteristics. They have a discount on the main residence. I think Spain has a €300,000 exemption. Norway operates a discount, so does France. They universally exempt pensions. They often have discounts or exemptions for the family company or the farm. I'll say now that we absolutely do not think a wealth tax can work unless you have a comprehensive wealth tax base, and that definitely would include pensions. There are various ways that you can tax pensions and deal with liquidity problems. If you do not tax pensions in this country, you would have to have a very much higher rate in order to raise the same amount of money. And given so much of people's wealth is in pensions, we do need to work out the case for how they should be taxed in a most efficient way. If you thought a wealth tax was a good thing, which I'm certainly not saying at this point. The other thing to bear in mind is that discounts, reliefs and exemptions are often given to solve problems such as liquidity or valuation, but they can erode the tax base, and in fact in the end they lead to abolition. And we've seen this in Germany, we've seen in France ultimately the wealth tax has been restricted to real estate in recent years. And finally, we do need to think about other taxes such as inheritance tax and capital gains tax. It's a very complicated system we have in the UK, probably one of the most complicated in the UK, in the world. Do we really want to have more complication with the introduction of a wealth tax? So that would need to be considered very carefully. And so I hope that even if a wealth tax is not considered or brought up now, that this paper, this work will be useful in future years. So if a politician jumps up and says, let's have a wealth tax, somebody will think to go to this project and actually have a real look at some of the hard decisions that have to be made. Our conclusions are going to be published on the 9th of December. We're having a launch then at 4 p.m. So it's open to the public, so anyone can log in and hear it. And please do give us some feedback on the evidence papers if you keep an eye on that website in the course of November. Thank you very much. I'll hand over back to Tony now.
So thanks, Emma, for setting out some of the issues that have been examined in the UK that will provide the basis of a rigorous and well thought out tax policy, so that we don't end up with a typical dog's breakfast. Becoming somewhat more international now, we've had the domestic Spain, we've had the domestic UK. We're going to ask Philip to talk to us and share some of his thoughts on possible future global initiatives, which I think absolutely will give food for thought. So please, over to Philip.
Okay, thanks very much, Tony. What I'd like to do is to really start out by referring to wealth tax and tax generally as part of political risk globally. A wealth tax is political risk, and there is a paper for everyone who's attending this program that I contributed to that talks about political risk in a very general way, but also touches on political risk as it relates to post-COVID taxation. And what we should all understand is that every single family we work with is exposed to political risk, because every single family we work with is international, either because family members are living in different countries, or they're investing in different countries, or they're using investment vehicles in different countries. And political risk, including the tax risk and wealth tax risk, arises based on where you live, where you're a citizen of. It also arises in relation to, of course, where you invest, the different countries you invest. But we also have to look at political risk and wealth taxation in the countries of the intermediate structures we use to own assets, including trusts, foundations, and companies, and all the other animals in the zoo. The main risk when we talk about political risk focuses on the right countries have to expropriate assets. But there are also other political risks touched on in the paper that you have, including freezing orders and vesting orders that third countries can put in place. All of these areas of political risk and expropriation link into the discussion about wealth taxation. And I like, as a result, to discuss this topic of wealth taxation in the context of political risk. Some of you may remember that in 2013, in Cyprus, with full support of the IMF and full support of the EU, a capital levy was imposed on certain bank deposits in Cyprus. What's a capital levy? A capital levy is a form of expropriation, in my view, but it's called a tax by authorities. And in effect, it's a wealth tax. And what happened in Cyprus was you went to bed on Friday with $10 million in the bank, you woke up on Monday and you found you had less than $6 million in the bank, and you were told a tax had been imposed over the weekend, a capital levy, taking away some of your assets. This was in and around the financial crisis, very, very relevant when we're talking about how governments are going to pay for all the costs of COVID. And my own view is it's not if we will see wealth taxes around the world and other tax changes, it's only a question of when. And of course, governments want to be very careful about the timing of new taxes because they don't want to chill economic recovery. So we're really talking about things that are going to happen in a couple of years and over the next few years, but an area that is absolutely important to the families we serve. In effect, what happened in Saudi Arabia in relation to the Ritz-Carlton Hotel and the holding of families there, that was a form of political risk and a form of wealth tax mixed in at the same time. Now, when we talk about political risk, there are lots of tools in the toolbox that wealth owners and business owners can use to minimize political risk. Among these are, in my view, diversification of the ownership of assets. I encourage families not to keep all their eggs in one basket. It's not just about trusts, diversifying between the different kind of vehicles that you use, diversifying where family members live, corporate inversions, use of investment protection agreements. Those of us who are tax lawyers or tax advisors by background, we tend to forget about investment protection agreements. We focus on tax treaties, but investment protection agreements can play a very, very important role in managing political risk and also in some cases managing tax exposures that may discriminate. And what we're going to see, I believe, in the future are more and more countries that attempt to impose wealth taxes and other taxes on people who don't vote. People who don't vote are foreign investors. Many of the families we serve, of course, are foreign investors around the world, and we have to be very, very aware of these things. And when we talk about wealth taxation, we can't help but mention that we are now in a world of enormous transparency. The Common Reporting Standard, FATCA, these have all transformed the information that governments have. And when we talk about political risk, we have to understand that governments that in some cases cannot be trusted are getting information they don't need to enforce their tax laws. I am a resident of Hong Kong, and as a result, under CRS, all the information about my bank accounts all around the world are provided to the Hong Kong tax authorities, even though they have absolutely no need for this information, given that Hong Kong has a territorial tax system and does not tax what I have in those foreign bank accounts. But I have to ask myself, can mainland China get access to the information that Hong Kong gets about my assets? The answer is probably yes, under a number of circumstances. Does this tie into political risk? Absolutely. Does this tie into exposures about what may happen in terms of wealth taxes? Absolutely. In Germany, there's been a very high-level review of whether imposing a capital levy to pay for the pandemic would be constitutional. The issues that we're talking about in relation to wealth tax are current. They're very urgent. Governments, we have to accept, are facing an urgent need for revenue in an environment where income and wealth inequality is growing and is a political and social reality. We as members of STEP, I believe, have a responsibility to engage in dialogue on these issues and to recognize that wealth and business owners have to be part of this dialogue, and we have to discuss wealth taxes as well as other taxes and how taxes are being imposed. But again, linking this to political risk, the issue of wealth and income inequality is being kidnapped around the world by populist leaders who try to get elected by promising that they're going to be helping the poor, while in fact they're trying to help the wealthy. But their political enemies, who again may be among our clients, are going to be the ones who are targeted with wealth taxes and other taxes. And I laughed to myself when we saw the first poll, which was the question of, will taxpayers accept a wealth tax? How will they feel about a wealth tax? Who cares? The reality is they're going to be faced with a wealth tax, and they, depending on where they're living and how they're operating, and maybe they should be subject to a wealth tax. It's not a question of accepting or not accepting, and we need to be part of the dialogue of how we address global income and wealth inequality while balancing the legitimate interests of wealth and business owners to be subject to fair taxation and not to have their assets expropriated. Now, when we talk about wealth tax and revenues, and we heard, from Patricia correctly, it's a very small amount that Spain is collecting and that countries collect on wealth tax. But let's not forget, there's also a psychological, political element to all of this, and it's a question of fairness. The reality is there is support globally, and it's growing for wealth owners being subject to forms of taxation that are fairer than the way tax systems are currently working. And taxing on wealth just makes sense. We heard from Emma references to the Swiss system in the area of wealth taxation. In Switzerland, it's not a tax on billionaires. It's a tax that starts at a very low level of wealth and is very much oriented to a simple reality. Some people live from capital, other people live from the money they earn. And the people who live from capital, whether they got that capital by selling a business, whether they got that capital through inheritance, whether or not it was subject to inheritance tax in the first place, the reality is if they are living from that capital, in my view, it's fair enough that there be a tax, a wealth tax, in relation to what they have, to be fair that they are to be taxed while the person who's getting up every morning at 7 a.m. To go to work and working a full day is being taxed as well. It's just really a question of fairness. I'm not talking about a Thomas Piketty type of tax where he talks about 95% tax rates on inheritance or otherwise. I'm talking about a fair new way of really taxing wealth owners around the world and business owners. And we really need to address this because the abuses are there. I want to conclude my comments by raising a proposal. And the proposal is really that we begin to think about something that current circumstances around the world are pointing, in my view, to an urgent need for. We need, in my view, to revisit the possibility of taxation that is not only imposed by single countries, but which is imposed on global citizens. The reality is that many of the families that we work with are lucky enough to have the ability to pick and choose whether they pay taxation. The vast majority in the world do not have this option, but the small minority that we work with are able to move from one of their homes to another one of their homes. They're able to navigate residence rules that really do not reflect the current mobility capability of family members. How many families count the days? I myself have an app on my phone that counts how many days I spend in each of the countries that I spend time in so that I'm able to monitor where I'm a tax resident or not a tax resident. This is just not right. This needs to change. We need reform of residence rules, and the elective tax paying by global wealth owners has got to go away. 10 trillion euros of assets were reported in the most recent year, 2019 figures, under the Common Reporting Standard. And this is just beginning, 10 trillion of assets. If we had a cross-border wealth tax on assets that are cross-border assets, in other words, assets that we're already aware of under the Common Reporting Standard, so it would be very, very easy to identify the assets, very, very easy to impose this kind of taxation. And if we made it a very low tax, let's call it 10 basis points, 0.1% of your assets, that would produce 10 billion euros in revenue to be administered on a global basis. And I appreciate 10 billion euros is nothing, it's peanuts when you start talking about tax revenues and tax generation. But I want to put it in the context that the World Health Organization has a budget of 50% of that amount, half of that amount. And the World Health Organization, that the US no longer wants to support, actually is funded 80% through voluntary contributions. I have a strong view that health around the world, climate change, many of the other global challenges are challenges that we need to encourage not individual governments to be raising revenue on, but we need to find a collective approach to make that work. And if we begin to extend that kind of approach to assets which are identified under FATCA, other cross-border assets and flows, the figures that can be raised with very, very low wealth taxes could be very, very substantial. And my 0.1% figure for somebody who has 70 million US dollars in assets would produce an annual tax of $70,000, which in my view is a very reasonable cost for global citizens to contribute to what this world needs. So over to you, Tony. Happy to take lots of questions if there are on some of the points that I've raised.
So just before we jump to the questions from the audience and from the panel, we have one more poll question, which relates directly to your presentation, Philip. And so, having heard Philip's presentation, do you think that the notion of a cross-border assets tax is one worth further consideration? So here we get the results. So Philip, a lot of support for your idea.
Well, thanks for that. And I'd like to say that we have a new special interest group in STEP, which is just being formed, which is a responsible stewardship of wealth interest group. And I encourage those both who voted in favor and voted against to join that group, because we really want STEP to begin to be part of a voice on behalf of wealth and business owners. And what I'm advocating is not socialism. What I'm advocating is a fairer, just world that protects wealth and business owners and really respects what they contribute to economies.
Thank you, Philip. So I think the whole panel now will come back in to the presentation. So Philip, I think you need to unmute yourself as well, because I think we're now all on show. There it is. Hopefully everybody can see us. Can I start the ball rolling by asking Emma and Patricia what they thought of the idea of a cross-border assets tax?
Okay, I'll jump first. I think it's an interesting idea. My thought really goes, I'm a kind of trench kind of person. So going to the trenches of a global tax, I mean, how would it work in practice would be one of the major concerns. Who would monitor the tax? Who would do the splitting of the tax? Who would be supervising? And I mean, we would have a global tax inspector to deal with. That would be interesting. And it tends to be the case that something that kicks off like a very good idea, it ends up being, favoring the big guys and all those smaller countries, which are, the ones who are supposed to be benefiting from this, are the very same countries that end up losing revenue in favor of the big jurisdictions. That's my reaction. So, yeah, an interesting concept. It's the execution of it and the monetarization of this that makes me think. Makes me raise some doubts on that.
I think Emma, we can trust the OECD more than we can trust Donald Trump on taxation.
I think the problem is that you are dealing with very different jurisdictions that tax things very differently. I mean, trust is an obvious one, and I could see some real issues over that. And in a sense, the introduction of the anti-money laundering and DAX 6 between European countries, including the UK, obviously has illustrated those difficulties, those very quite nitty-gritty but important design difficulties, because I think the OECD and the rest of Europe are very suspicious of trusts and tend to want to tax them quite significantly harsher than, say, other vehicles that they would more typically use. And I mean, like all these things, the devil is in the detail, and the design I could see, as someone who's just gone through wealth tax design and it's nearly killed me, the thought of having to look at a global tax wealth, I think that probably would finish me off actually. But I mean, it's interesting, and my mind was worrying about how you would design it. It's just that you would have to be quite careful about not making it too complicated, and people will fight for exemptions and discounts, and then the whole base is undermined. It is difficult, this stuff.
So thank you. We've got a couple of interesting questions, I think, coming out of the, from the attendees. I think a fairness point, which is actually something that I was wanting to pick up. So Margaret O'Sullivan's asking about fairness. And so the specific question is, if a person has earned their wealth as opposed to having inherited it, is it fair they should pay a tax on their wealth? And it goes, what is fairness and what is expropriation? And I think there is this whole question of what is fairness and who decides what is fair. So I think probably that's for you guys to pick up and give some thoughts around what is fairness and who decides.
Well, Tony, if I could jump in, fairness is a very subjective term, but if somebody inherits $10 million and somebody living down the street in a much smaller apartment, than this person is living in, is working every single day to support their family, for me, there's zero question that fairness suggests that there should be a tax on the person who inherited that capital, regardless of whether their mom and dad, on death, there was an estate tax or an inheritance tax at that time, regardless.
I mean, maybe I could come in. I think there is a real issue of principle about the difficulty of taxing people annually on wealth that they have chosen to earn and save, compared with taxing them on transfers of wealth. And actually, this is one of the economists' big gripes with wealth tax. In effect, you're taxing people throughout their life cycle just because they may choose to spend their wealth at different times. But there is something, I think, quite difficult in principle about the idea that someone who has been a fantastically successful entrepreneur has to pay a wealth tax, but you wouldn't necessarily tax them on inheritances. People who've not done anything with their money and just inherited it. So I think there are difficult issues of principle. I think there are some aspects of wealth tax in design terms that make it easier than inheritance tax, but there is that fundamental principle one has to get over. I mean, there have been quite a few questions in the chat about capital gains tax, and I agree that capital gains tax is a tax that does need to be looked at. My fellow writers, Aaron Advani and Andy Summers, have done a lot of work on this. You can go online and have a look at what they've produced about capital gains. I think there are a number of different aspects. One is that if a lot of capital gain is generated because people structure themselves differently in terms of how they work. So if you form a one-man company as opposed to you're an employee, you may well be able to get lower rates of income tax and, of course, access capital gains in a way that an employee can't. And they've been looking at this and also the distribution of wealth. So there is quite a lot of academic work at the moment on capital gains tax. And of course, we've got the OTS, Office for Tax Simplification in the UK, also looking at capital gains tax, not just limited to simplification, but also looking at some policy areas.
On the issue on the issue of fairness, from the experience here in Spain, Spanish government do tend to use wealth tax as a kind of showcase to say, see, we're addressing the fairness issue. And they typically use that, and excuse my cynicism, in order to mask the real increases in taxes, and the raising 2 points on VAT or raising 3 points on income tax, which is the real source of revenue, and in order to kind of as a sweetener to those raises, which are the kind of raise that brings the money in, they say, see, but we do have wealth tax to address the tax inequalities kind of thing. So the use of the notion of fairness, which is a very, I agree, it's a very noble idea. It's typically kind of twisted and turned by governments to kind of say, tick off that box kind of thing, while trying to raise taxes among the general population, which is the real tax revenue coming in.
Both you and Emma have made comments that I wanted to add to. The whole issue of fairness, simplicity is something that Emma touched on, and I think fairness requires simplicity. What we see around the world are headline tax rates that are just untrue. The people who pay the high headline rates are the wrong people. We see, Donald Trump paid $75 or whatever it was in taxation. But this is, he may be an extreme, but it is the case around the world. So the vision that I would have would be a world in which the headline top tax rate is extremely low and attractive, but the tax system is extremely simple. In the UK, even a tax lawyer like me, trying to navigate the res non-dom rules and the residence rules, you need to spend tens of thousands of pounds to get advice in order to navigate those rules. So only those who can afford that advice can actually, navigate them. That's just not fair. That's not fair. And I'm also a great believer that you can reduce tax rates dramatically if you simplify the tax system and you widely broaden that tax base and hypothecating some taxes. I know economists hate the idea of hypothecation of taxes, but actually having numerous taxes where people know what they're paying for changes the relationship of how people feel about paying taxes. I don't know why tax authorities don't allow you to pay more taxes than is actually due. Why in your tax return is there not a provision that says, do you feel you've paid enough tax? Would you like to make a voluntary contribution of more? Because philanthropy, the clients that I work with, they'll do anything to avoid tax, and then they'll give money away to charities that are in many cases corrupt, not well governed. Meanwhile, it's the governments that we rely on for our whole futures and the futures of our children. We need to change the relationship of governments and wealth owners dramatically. And wealth taxes is one piece of it.
Yeah.
I agree with that. And simplicity is absolutely key here. That you should have been at some of the debates I've been having with academics, because it is a massively complicated system. That there is an interesting book I think Dominic Frisby wrote, called Daylight Robbery, and very much on those lines about low flat taxes with a broad base. And it is interesting. I mean, the OECD consistently says we must have a wealth tax with a high threshold. And indeed, the US model that came out was very much on those lines. And yet, if you look at the wealth tax countries that have been most successful, they have a low, flattish rate with not very many exemptions, a broad base. And then people buy into it. As soon as you start introducing exemptions, it's like IHT. Everybody starts feeling resentment because they can't benefit and the rich person can.
Exactly.
And IHT is regressive. Above 3 million, you pay less and less tax proportionately. So these regimes need some radical looking at.
And it creates divisions.
Yeah.
Emma, what you've just said, it creates a them and us atmosphere of, only the billionaires are paying the billionaire tax and all this kind of thing. And really, we are one world, it's a fragile world we're in. And some are luckier than others. Some are, whatever, they've had opportunities, they've made more money, but we need a different conversation. Conversation.
Can I jump in, because I'm sorry to cut you out there, Patricia, but we are really at the end of our time. I think we have time for one more question, and I'd like to get that question in because I think it's an important one. It's the link between taxation and economic benefit to the to the whole country or to the whole world. So there are two questions that have come out around this, which are both in this area of how does taxation impact the economic benefit to the country, and is there a recognition of that economic benefit? So are we actually cutting off noses to spite faces by taxing, or the suggestion being that we're overtaxing, or are you comfortable that isn't a problem in this area?
There's no question, Tony, in my mind, there are too many pools of untaxed capital in the world. And many of the people who are on this call are the people who are the few in the world who understand how this works. I mean, how many of us are involved with structures that may have a deceased settlor and the trust is not making any distributions each year? And we have families living around the world, which as a result, under the current common reporting standard rules, there's no reporting. Governments don't have any information on that pool of capital. And the family is able to go generation after generation with zero taxes being imposed. That's simply not fair. It's simply not right.
Yeah, but you're not saying that people who've made economic wealth and benefited the economy, you're recognizing that benefit, right? You're not saying that there isn't a benefit at all.
Yeah, I recognize it, but it doesn't give you a free pass forevermore in your family.
No, absolutely.
Yeah, I think on that point, I think it links to the previous discussion regarding simplicity. I think simplicity is fine. If you keep the tax on a certain category of assets, it's easy to have a simple tax on real estate, but it's not that easy to have a simple wealth tax on business property and shares, because you do want, one of the key public policy issues typically is that you do want to protect your business environment. If you start taxing shares in operating businesses, then you end up, having implications well over and above wealth tax. So simplicity, yes, but it typically means capping the amount of assets that you're subjecting to the tax.
Now, I'm going to jump right in there because I know that is going to produce a massive response from the other two, which would take another hour if we let it.
Well,
let's leave it that there are a lot of issues to work through, because there are both sides to this debate, and I think we've heard Philip and Emma's view about simplicity and tax base. So I think we know what their answer is to that, and there is a debate to be had. Shall we leave it at that? There are two sides to this story. So thank you to our three panelists, Patricia, Emma and Philip, and to everyone who's attended today, and also to those who've posed questions. I've really enjoyed today, and I hope you all have as well. And for as far as this webinar is concerned, that we have to call it a day now. This is only number 2 in the series. The next webinar, it will take place on Wednesday, the 18th of November, and will cover mental health and the financial advice relationship. You will all get a link later today to the recording of today's webinar, and you will also get an evaluation form, which we would very, very much appreciate if you could fill out. That will help us in planning for our future events. So once again, thank you to all. Very much enjoyed this, and look forward to seeing you all again soon. Thank you.
Thank you. Thank you. Bye.